taking control of your future and what you want to be invested in, when you want to do it. I talk about return on equity, and then I talk about return on energy. You know, if we are really heading into an inflationary market, you want to invest in growth. And I think we're seeing some of that now where people really bought heavy in 21, 22. How much real estate's in the United States of America? 400. Let me talk about the capital markets. There's a certain weight that comes with you're owning 150 units by yourself or 30 units by yourself or a duplex by yourself. I mean, there's a weight to that. I don't think it gets talked about. Now it's getting talked about because all of a sudden if you've got a loan coming due and you've still been paying your 8% pref, but you haven't recognized that your equity is down 30% and you're going to have to do a capital call to all these investors that you went to. I mean, there's just some scenarios that have come to light. If you need liquidity and they're fine. So I see there's so much value in a marketplace. Let the market set it. Because again, you don't have to sell too, right? However, knowing what that market value is and knowing where you are when you check in, you guys are providing a massive service. You know, like when the market turns, like I would have loved to have had some liquidity the last 6 months to a year just for fun.
Hi there, welcome to the Fundication Show. This is a brand new episode. I'm Julie Tallman and I'm with my co-host Christian Sadler.
Hey everybody.
Today we have a local celebrity. We have really the go-to name in multifamily brokerage, Mark Jensen, Colliers. What's your title? What's your position there?
I would say they would call me a vice president of investment sales, but I'd really just consider myself a student of housing and just a housing expert in Utah.
He knows his stuff. He has done 5,000 units in 9 states in 4.5 years.
Yeah,
that's a big accomplishment. I've seen his name all over the state, and here we get to meet you. Thank you for being here today.
No, I'm honored. You guys are doing wonderful things, and I've known Christian for many years, so excited to be here. Appreciate the opportunity.
Perfect. Good. We want to hear all about your team and how you became successful, and we have a lot to talk about with syndication and multifamily.
Yeah, Mark, it's so cool. We've been connected for so long, but never really spent a lot of time in the same place or having, in-person conversations. So you've been in the real estate space just a little bit longer than I have. You've actually been a broker for 19 years, right? Is that correct?
Yep. I started October 15th, 2004. So my birthday, not my birthday, in the business. Got it. I'll never forget it.
Yeah, very cool. So I think before we jump into some of the content and talk about how people even get into multifamily real estate and, the different things you've seen out there in the market, I'd love to just hear your story. Give us the Cliff Notes version of what even pulled you towards real estate, and then how did you end up where you are now?
Yeah, awesome. And I don't get to talk about myself very often, so I actually don't know how this will come out, but I've always loved real estate. My dad was actually, for many years, was the CFO of Mountain States Mortgage. At the time, they were the largest servicer of residential mortgages in the U.S. I just remember this number in my head. They had $2.8 billion under service, under management, if you will, just the servicing aspect of it. When I was in college, I managed a couple of cell phone stores, but at night I would go home and I would cold call for mortgages, because back then you would knew their rate. They would publish your rate. So you could call Cindy Adams. I started in the A's because I would cold call. And you would call and you just say, hey, I know what your rate is. We can bring you from 4 3/4 to 4 1/4. It saves you this, doesn't cost you anything. So it was just really fun to get in the finance side. I got into real estate in 2004 after I graduated from the University of Utah. One of my best friends, his name is Ben Brown. Hey, Ben, shout out. He was in retail, and I break real estate into kind of a few different things, but I usually talk about vertical real estate versus horizontal real estate. So they would represent retailers and help them expand, whether it's Walmart or Cold Stone Creamery or Barbacoa. They'll help them find additional locations and stuff. But I really was attracted to the investment side of real estate. So one of the first projects I worked on the leasing side was actually a movie theater in West Valley, in Kearns, if you will. And it was vacant. And, I went to that owner and I just said, hey, I'm new in the business, you have a vacant building, can I work on that? And so I actually made a whole bunch of cold calls, ended up getting, you remember Peg Leg Paintball?
Yep.
So I got Peg Leg Paintball to take it as a store in the front, and then this is a long way of giving me an intro, so I apologize, but it'll kind of give you an idea of kind of how I think. So I actually got Peg Leg to do their first store with an indoor facility, so you could go in there and you could actually play paintball. And then we ended up figuring out the lease rates and all that stuff. And my client then said, hey, do you want to sell this? And at the time I was doing the same thing in Tooele. We had a small retail building across from Walmart there that I leased up, and that owner said, hey, do you want to sell this? So understanding the financing side, understanding math, was able to put together a sales package and valuation, and we went to market and sold both those assets. And technically I didn't sell the Kearns deal. That's Peter Clark. So was my first client and a great guy, but I did sell the Tooele deal, and that's kind of how I got on the investment side of things. But I've always been attracted to housing. We'll kind of talk about that too as we kind of get further into this, but have always liked housing. It's something that everybody can understand. Coming out of the University of Utah, it's like I knew several people that had rented. Everyone's been a renter at some point, and I kind of really understood those buildings. And so sort of coupling the math side of my understanding of finance with the rental rates and valuations of these buildings, it was kind of an easy transition for me to get into the multifamily side of things, and no looking back, right?
Yeah. Now, did your schooling lend to that? Did anything that you did in schooling lend to your real estate, or was it just that you kind of plugged in with your buddy?
Well, to take one step back, after I graduated from the University of Utah, I went to work for my uncle. I thought I needed to get a job. My uncle is one of the largest flooring contractors in the Western U.S. by volume. He owns wall-to-wall flooring, which they just celebrated their 100th year anniversary. So shout out to my parents because they're still involved in the residential side. But I thought I needed a job, So I took a reduction in salary, and I went and tried to sell flooring, which flooring is a phenomenal industry, but there's a lot out of your control. And every time I'd go to a building and sell them on flooring options, which I know a lot about flooring, we don't need to get into that. I'm a flooring nerd. You can ask my business partner. We still go into apartment buildings, and I'm like, looking, is this LVT and is it straight? But every time we go to a building, I would ask the owner about the building and who the tenant is and how many tenants are there and how much did it cost to construct. And I was clearly interested in the real estate side of things. So my uncle took me aside and gave me the best advice I've ever had. He basically said, you have no kids, you don't have a mortgage, this is the time you need to go do what you want to do. And at the time, Ben had been in real estate for a number of years on the retail side. And there's a long story to how I got in, because it's not easy to get into real estate, it's particularly commercial real estate, but fought my way in. And that's kind of how things began, if that answers your question.
Yeah, absolutely. Yeah. So that's huge. And now you're doing a tremendous amount of volume. You've seen a lot. You've seen the ups and downs of the market, obviously being involved for 19 years. Does anything stand out to you as like the craziest story that you've seen in real estate?
Oh man, I have probably way too many crazy stories. We didn't talk about that in the green room. So I could go on for days. I think that if something that stood out, one thing that stands out is the people that are successful in our business, they're in the business. There's a lot of people that are like, hey, I kind of want to do real estate. And we'll talk about, the investment side and the LP side, which obviously just find the right sponsor, the right thesis, you'll be great because there's experts in the market. But there's a lot of people that kind of dabble in and out. The people that are in the business, you can just tell. You just know the difference. If things are bad, they're still doing whatever they need to do to make sure their assets perform and that their company's safe and, all those things. We can kind of get into some of that if it's important. But I think what stands out to me is that you really want to be working with the people that are in the business. And advice to young people too, don't dabble, just go all in, one of the coolest things that I've heard is Coach Whittingham. He always said, you're either all in or in the way. And I kind of feel that way about real estate. Like you're either all in or there's other people like I wouldn't want to compete with me, for example, in the multifamily space. I just know too much. So, in that regards, everybody's got to start somewhere, but you just want to make sure that you're all in. I think the people that are all in the business,
I love that
are all in the business, providing value and an inflow of information that's constantly changing. I think that's just, that's what stands out in Utah in particular. We've got a lot of people that are all in doing wonderful things in a very, very fast changing, high growth market.
Speaking of all in, I want to talk about your team because you do have a really esteemed team. Can you kind of tell us about the structure and why your team is maybe more successful than another team?
Obviously you can't do anything yourself. You guys have a great team here. I had realized late in my career that just being yourself is pretty hard to scale. And if you really love what you do, you really want to provide as much value as you can to as many people as possible. And I just realized quickly that in the brokerage side of things, you're everything. You're the guy, you're the CEO. You have to decide what you're going to work on, Then you have to go find that product. And usually it's not owned by you. So you have to tell that person why you're the best. And then they hire you. And then you go through the whole process of marketing the asset and negotiations, and then going under contract and due diligence. I'm boring everybody, I realize, but you can just see where that just gets crazy. But it's also really simple for operations people to recognize, hey, you could really figure out what you're great at, what you want to do, and then there's people to fill in those other pieces. And we do have a wonderful team. And in 2018, and this is getting to the market, right? Our market has grown up tremendously and changed tremendously. And I realized too that I was the guy that sold a duplex and a fourplex and a 16 unit, then a 25 unit, then a 100 unit, and just sort of hung out in this, what I would call normal Utah, because up until about 2014, 2015, it was, our biggest asset at the time. We had some stuff built in the 70s, the 80s, the Palmers. They built the biggest deal, which is Summerwood, which is 800 plus units. I mean, that's crazy to think about right now. We don't need to get into that, but most of our product is actually sub 150 units, right? But then all of a sudden we started building these really big deals, and our market really got institutional attention. And so my business partner, Raleigh Nielsen, he came here from the Bay Area, originally from Utah, went to BYU, but go Utes. Every team needs, you gotta have everybody. You gotta have a balance. Raleigh's definitely my balance. So he really had a ton of institutional experience because San Francisco is very institutional. And so we connected in 2018, officially became partners in 2019, really to provide that everything from land acquisition and construction underwriting and design, all the way through selling a 20 unit built in the 70s in Clearfield, all the way to selling institutional deals. So, and I love it because I crave optics into everything, right? I want to know what the institutions are thinking. I want to know what Sally from LA is thinking. And because all of that information combined kind of gives you this amazing optics and vision and clarity into what is happening in the market, trends and opportunities we catch very, very early. I mean, that's kind of my jam, is really being part of the flow of information in multifamily, and that allows us to really gauge the market and give really good advice to our clients and literally just be the best team we can. But let me get back to the team. Jared Whipple has been with me for a decade. He's our operations manager. He's amazing. Luke Mata came to work for us about 2 years ago, handles all of our underwriting and data because we're a non-disclosure state in Utah. Now I'm talking really fast, but you're understanding where I'm going with this. Rachel Smith came out with us about 2 years ago. She does all of our design and marketing. And so our team is really functionally perfected to handle anything you have. You need equity, you need information so you can raise equity, you need to understand valuations for tax purposes, you name it, we have everything. We track every investment sale, we track all the lease ups, the construction pipeline in the state. Again, we've done, thousands of units in 9 different states the last few years as capital has chased things regionally, which we can get into. And that's a whole lot of talking. So we have a great team, grateful for them. And we've built something of value, as I like to say. And we love it when people can tap into us because we don't compete with you. We're a massive bolt-on.
Yeah. And that's one of the things we were talking about out in the green room is how vitally important the data is. How do you keep track of all of that? How in your own mind and your own systems do you keep track of what's important to the conversation that you're in at the time?
Yeah, and I think that's kind of the all in, right? I can't imagine doing anything else. So how do we keep track of it? Every conversation I have, we take information. Like I said, we just came from touring a property in Provo. I have lease up data, I have rental data, I have who the equity is, who the lender is, and I just go from meeting to meeting to meeting to meeting. And so I've got so much information up here. I don't always know what to do with it, but from a very simplistic, taking a step back, we track every investment sale. So every time a transaction trades over 12 units, really, we make sure we get all of that data. And there's some holes in the non-disclosure state. We might not have the T3, but I might have a rent roll from 7 years ago or whatever it is. But we have the best sales comp data in the market because I've been keeping it since 2004. So, and then we have a couple of programs we use if it's worth talking about. One of them is called VAL, which is what we do all of our projections in, but we really keep most of our data in what we call Red IQ. So anytime I underwrite a deal and they send us a trailing 12 P&L, and a rent roll, we put that into Red IQ. What it allows me to do is say you're going to build a 25 unit townhome deal in Salem. Like I can go into Red IQ because we underwrite deals, whether it's for a refinance or a sale or another competitor is selling that deal. We get all that information. It goes into our database. So I can immediately produce budgets across the state of Utah, across product types. And if you said, hey, we found this 1970s deal, it's 12 units by BYU. They're all 1 bedrooms, but there's this one weird 2 bedroom. It has this extra room. Like I can literally go to Red IQ and pull out 7 properties that are similar to that we have underwritten in the last few years. Usually it's within the last year because we do probably 10 to 20 what I would call broker opinion of values every single month just because we're tracking stuff. And for months and months and months and years and years and years, that all goes into one singular database that we could tap into. So I can show you what that's going to look like post renovation and stabilized in minutes. Anyway, so we track a lot of data.
That's huge. And it makes you vitally valuable to the clients that work with you.
Yeah.
Here's one thing I'd like to help the audience understand, because for many people, they look at a 150 unit apartment complex, for example, and they can't even fathom what it looks like to own that. They don't know anybody that's ever owned, a building of that size. Who do you see that are buying these, and what are the different ways that you see them, coming up with the money to buy a multifamily unit of that size?
Yeah, super great question, because I've never thought until you asked me that in the green room, I've never thought about, like when I drive down I-15, you don't want to be in my head. Because I know everything about every building. I know when they put it under contract, what they paid for it. I don't need to go on to that. So yeah, when you drive by a building and you see it and you don't know, you don't know. You don't know, is that one wealthy guy, named Steve? So it is really interesting to see those deals. And I have full transparency behind the curtain. Who does that cash flow service? Who do those valuations service, whether it's income or tax savings and things like that? I think you'd be surprised what it boils down to is it usually goes to a lot of people that have put together their money to invest in and buy these large assets. If you think of like a fund, like a Texas Teachers Fund, that's a pension, right? So that cash flow, that investment services thousands. What it comes down to is, the large assets are just a bunch of people that have put themselves together to do that. I will say one thing that has really become obvious in my career is lots of people can buy a fourplex. Not a lot of people can buy 150 units. And so there's typically real spread in returns in those. I mean, people call me like, hey, I've got $500,000. I'm looking at this duplex. Absolutely do it. Because you get appreciation, you get depreciation, you can self-manage, you can hire a manager, obviously that building will continue to appreciate over time. But at the same time, if you want to be hands-off, like we were talking about earlier, investing with a group or investing as part of a larger group that buys bigger deals. Investing in a 150 unit is you're competing with the open market. If I've got $1 million right now, you can go get a CD at 5.25% or 5.5%. So why would I go buy an apartment building that's going to break even? And that's what the natural market does. What these larger apartment complexes allow these big investment funds to do. If it didn't make sense to invest in multifamily, they don't. Money is brilliant. Money is very smart. And there's a lot of people behind all of that money that's getting placed in different places. And so the latter part of my career has really been in understanding those capital markets. I sat down with Milestone in 2013. They're a top 50 owner in the U.S. based mostly in Dallas. And I wasn't even like the reason. I was in the meeting. I'll just put it that way. But I'm sitting in the back, and they're talking about why they're selling their 6 assets in Dallas and buying in Orlando. And this is what your founder has done quite a bit of, right? Yep. And I'm sitting there thinking about how much money they literally just moved. I'm like doing the math, $2 billion from Dallas to South Florida. I mean, that's crazy to me, right? But why do that? They see more growth over here. So that's what the big dollars do. They're looking for growth. They're looking for, where am I going to get the highest risk-adjusted return in the market? Where's my money safest? That's probably the number one. Where am I not going to lose money? So anyway, I think I probably overstepped my bounds there a little bit, but you get the idea.
Perfect. And you actually led to, because Mike Anderson with his previous company, they did what they called dynamic re-leveraging. So they would take somebody that had money because they had a fourplex in San Francisco, for example, that was paying them a 3% return or something. Yeah. And they would say, did you know that if you sold that right now and you went to I don't know the place, but let's call it Iowa, right? You go to
Sioux Falls, South Dakota.
yeah. So you go over here and you can get 3 times the amount of cash flow for that equity. And he teaches us a lot about this concept of the longer that you hold a property, it deleverages itself, because while you're growing that equity, now that equity is not getting the higher return.
Yeah.
And we'll get into this, I'm sure, later on when we talk about the secondary marketplace and being able to re-leverage even as a small owner in some of these is part of what we're pioneering. But what you're basically talking about here is that dynamic re-leveraging aspect.
Yeah, and I'm going to say I probably can't patent this, but most of my meetings start like this. I talk about return on equity, and then I talk about return on energy. And you're absolutely right. Like a client that I had, this is probably 2013, he owned an 18 unit called the Highlander, which is on Highland Drive, about 45th South. And I can probably talk about this because it's long enough ago. But 18 units, he's self-managed them. He'd owned them since, the 80s, So I meet with him and he's like, I'm never going to sell. I'm never going to sell. It's like, well, let's walk through some numbers, It's like, wait a second. So I think what it turned out to be is like he basically netted about $50,000 a year, but he's there every day.
Yeah. Like
he's the one doing the leasing, he's the one changing the carpets out and repainting. And so the conversation was really like, how much are you worth, And it's like you could go get a job at IHC and get benefits, and they'll pay 45. So you're basically making $5,000, Let's talk about the return on energy. And so we ended up 1031 exchanging him, re-leveraging into a triple net retail deal. We actually bought a Freddy's in front of Costco in St. George, which was amazing. 15-year lease, and he literally tripled his cash flow. And now he doesn't have to go see it. So yes, that's exactly right.
Yeah.
Equity builds up. You kind of have to be on top of it, and maybe you don't need to, but when you do check in, as we say, you want to think about that return on energy and return on equity, and where is my money best invested over the next 10 years?
Right.
So you mentioned, there's so many people that have a fourplex or a duplex or whatever. If somebody does want to move from that to the bigger game, if you were to just sit down with a buddy or, a son of a buddy and say, this is how you start out, or this is what you should do, what's your line of advice there?
Well, the first thing I would say is, that's awesome. You own real estate, like you're already in the game, The second question is, let's figure out how much equity you have. And then the question becomes, where do we put that equity? Let's just say you have $250,000. Is there anything wrong with leaving it where it is? Probably not, But are there other things you could do to improve that? And maybe it's a lifestyle thing. And a lot of it depends on where you are in timing in your life. So when I first meet with clients, I put them in one of two buckets. You're either in capital creation mode, which is most people, we want to go make money, or you're in capital preservation mode, which is like, we just don't want to lose money and we live off of this, And a lot of people are kind of in between, and most portfolios have a little bit of all of that. You don't want to sell everything and go into something really risky or something, even though it's, you'll risk adjust return and look at that portfolio. But I would just say, let's just look at that money. Let's look at that equity you have, and let's just talk about options. I think what's interesting is people set it and forget it. And I think to your point, what you're saying that Mike did was essentially just checked in with those people, and that's kind of what I do is we go consult with them and just say, where are you? And let's check in for a second and see what opportunities are. I mean, one of my favorite deals was a storage unit complex, and I won't name names because they're still real time in the market, and I love them to death. They're one of my best clients. But they actually had a storage unit complex that they both ran, husband and wife. So I kind of went through that same scenario. They'd owned them for 25 years, and amazing cash flow. But if you look at what your time is spent there, your return is probably 3.5%, 4%. So we ended up actually buying them a multifamily apartment complex, and believe it or not, a car wash. And again, tripled their income, more hands off, really changed their life. So the return on energy and checking in is important, but you don't have to do anything. That's the beautiful part. Most of our clients, you don't have to do anything, but let's check in and let's just see what opportunities are out there. Let's see what other investment vehicles there are and where are you in your life type thing. So
I had a financial advisor, real quick, said, if you're not checking in with your money at least monthly or quarterly to go, what is the highest and best use?
Yeah.
Then it's just going to find gravity and settle out.
Very well put.
Yeah.
Yep.
Well, and it's interesting because we just had Kim Lockridge in recently, and she does a lot with cost segregation. And so she talked about car washes. I'm curious if with that couple, was the car wash part of the tax strategy in addition to buying the multifamily unit.
Yeah, 100%. So believe it or not, I've sold more car washes in Utah than anybody else. Because this goes back to early in my career. What I was really curious, what does $1 million get you? Right. And so that's really where the return on energy came from, because I got out of car washes because it takes a lot of energy. You're buying a full-time job, right? But they'll pay you. At that time, we were buying them at 12 caps. So if you buy it for $1 million, it's paying you 120 grand a year. So the thought process was like, well, I'm going to run it, but if I need to pay somebody 40 grand, you're still making 80 grand on $1 million, 8%, plus the tax bennies, you know. Yeah. So there are some benefits to that. But yeah, absolutely. Tax strategy, they were pretty spread out on their roles and responsibilities, if you will. And this was like, it's right here, you know, pretty simplified, but absolutely the tax rates are nuts. Being able to depreciate all the equipment in, you know, the first 5 years, like you're not going to pay any taxes. Mm-hmm. So yeah, the cost segregation is big. It's big in multifamily. It's big in anything that you go invest in. Absolutely. So I'm glad you had her on as an expert in the space. Interestingly too, like even if you bought a deal last year, you can still cost seg. Yeah. People that haven't cost seg, go figure it out, because it's crazy.
Worth it.
So do you see a lot of single buyers on these big complexes? And if so, like where do those people come from?
Yeah, I mean, I think the single buyer is interesting because, you know, a lot of people do make their money elsewhere, and then you want to go into real estate for all the reasons that you guys know and we talk about. There's not a lot of that. You made your money someplace else. You know, it depends on how much money you've made. If you made $1 billion, you know, you're fine, and you hire people and they help distribute that. But, you know, like a client of mine recently, they sold a bunch of I won't say which chain, but a well-known fast food restaurant chain that he was a big franchisor of that. And a lot of his reasoning for doing the sale was so that he could 1031 exchange into real estate. And, you know, he was a pretty significant buyer. Most of the single buyers, I would say, are anywhere from a duplex up to 50, 75 units. It's pretty rare to get somebody that's a single buyer, unless they're in that space, that doesn't syndicate to go into kind of some of those bigger units. Because especially right now, when your loan to values are 55%, you know, you're having to come in with 40 or 45% equity. You really can't go buy 300 units. Nobody's running around with $80 million by themselves right now. But if you are, call us. We're ready. But usually there's a strategy behind that. But lots of people have made their money. You know, like say you're in California, you're in LA, you're in San Francisco. You talked about political reasons to move capital. I mean, the checking in part is absolutely what is going on in, you know, macro to micro, and how does that affect my investment over time? Because there's a lot of people checking in right now. A lot of it's generational. We're finally seeing in Utah, we've had 4th, 5th generation California or Washington or Oregon or Illinois or New York. I'm going to keep going. They're all worried about politics when it comes specifically to housing and rent regulation and stuff like that. So if you're worried about limiting your upside, you don't want that with an investment. You want to have limited to no downside, and you want just clear blue skies. And there's certain markets that offer that clarity much better than others.
Yeah, that makes sense. I mean, you even hear about some of the bigger families here in Utah. So I think about the Millers, for example, that just bought Daybreak, basically. Yep. So they're moving their money from other industries into real estate. Yeah. And I'm sure you understand some of the key reasons behind that. Why don't you share some of that of what you're seeing?
Well, first of all, shout out to Carl Duke, because Carl worked for LDS Church for many, many years, and he's probably the most educated real estate person on planet Earth, and I hope he hears that. But he's an attorney. He got his master's in land planning, and that's like he's got an engineering degree, land planning engineering degree. So, hey, Carl, Larry H. Miller knows what they're doing. You know, if we are really heading into an inflationary market, you want to be in real estate. But I'll tell you, the number one place you want to be, real estate is really easy. It's colored by numbers. You want to invest in growth. Yeah. You know, one of my favorite books recently was called Upside, and I think his last name is Grover, but I love his opening line because he says, I used to go to parties and tell people that I was a demographer and nobody would talk to me. He said, now I go to parties and tell people that I count people for a living. They're like, oh, that's interesting. But that's really what you do in real estate. If you're counting people, you want to invest where there's growth, you know, in Utah, Idaho, Montana, Florida, Texas, Georgia, Carolinas, you know, you're clearly seeing outliers of growth, and that's where you want to plant your flag. And so kudos to Larry H. Miller for doing that. Where is there going to be growth? I mean, Utah, but specifically, you know, in those growth markets in Utah. So they're doing a lot of great stuff. But the one thing I will say is community is your best amenity. and they are creating communities.
Yeah.
So they are putting their money in the right genre, but they're also just building their own insurance policy of amazingness with what they're creating. And they're doing that all over the place. So it's going to be really neat.
Makes a lot of sense. So you talked about the fact that most of the big units, the big apartment complexes, 100 plus, are going to be owned by a syndication of some sort.
Yeah.
It might be a retirement account that comes in or a conglomerate of whatever it is. Talk about maybe I don't know how to phrase this, but the good, the bad, and the ugly. What is the ideal client that you think is going to be the most successful? And what are the ones that you kind of get shaky about and wonder, is this person, should this group be buying this unit?
So this is going to sound really bad, but I posted on LinkedIn in 2017 that my mom is now a syndicator. And she just sent me a package and 17% IRR and 8% pref equity, preferred return. I was totally joking. But something has happened the last, we'll call it 2014, 15, 16, 17, as we've come out of the GFC. All of a sudden, the buyers that were buying had babies, and their babies had babies, and all of a sudden, everyone was a syndicator. It was crazy, and people in our space will understand that. I worried a little bit about that, and I think we're seeing some of that now, where people really bought heavy in 21, 22, high octane loans, as I call them, 75, 80% loans, 2 to 3 year horizons where they have to be repaid. And now we've hit a reset. I was talking to a developer earlier today, and he said there was really no canary in the coal mine. It's like, we need housing. We'll talk about that too in Utah. And I don't know how much you want to get into like current market, things happening. But the reality is we've seen this immediate shift in valuations based on what buyers can pay, from a number of factors. Really, it was interest rates, but now it's become operations. We've seen some softening in the top line. And anyway, we'll be fine because we need so many units. We have 17,000 net immigration projected just in Utah for next year. Where those 17,000 people are going to live, we're going to be fine. Plus, we're the number one population growth state in the nation, also the youngest, most educated population of the nation. We're going to be great. But yeah, I love that. So I think, and we were talking earlier a little bit about this, it just seems like I know too much. I would never want to discourage somebody from getting into real estate. I don't own real estate personally, other than my home. I have invested in deals. I've put deals together where I'm a really small investor, but there's a certain weight that comes when the market shifts. There's a certain weight that comes with you're owning 150 units by yourself or 30 units by yourself or a duplex by yourself. I mean, there's a weight to that. I don't think it gets talked about, but now it's getting talked about because all of a sudden, if you've got a loan coming due and you've still been paying your 8% pref, but you haven't recognized that your equity is down 30% and you're going to have to do a capital call to all these investors that you went to. I mean, there's just some scenarios that have come to light, the last couple of years, and maybe some of those groups were new to the business. That would be my only comment. But again, I'm careful because there's plenty that are going to be super successful, and kudos to them. But the market cycles, real estate cycles. And if you're not really positioned well for that, now is one of those times where you're kind of having to recognize that.
Yeah. When did you come to that realization that you didn't necessarily want to be the one owning the real estate? Because for me, I'm pretty far into the business and I'm just barely getting to this point where it's like I'm starting to meet all of these passive investors and see that return on energy, like you're saying, where you can literally find a real good operator and let them deal with that weight, like you're talking about, and let them deal with fixing all of the challenges. Because I was always, me and my business partner and whoever else we had involved in the deal, we're always the ones, chasing and fixing and trying to solve problems and get contractors to do what they said they were going to do in the first place. When did you come to that realization that you didn't want to be the owner of real estate, but you wanted to be heavily invested in real estate?
So I would tell you this, own real estate. It also goes back to that, show me your friends, I'll show you your future. I was young. I wasn't around people that owned a bunch of real estate. I was in a brokerage service business, which I think I default to. It's in my DNA. I mean, I didn't drive around looking at deals saying, I want to own that for these reasons. I actually wasn't that educated early on. I understood the finance side and sort of wanted to be in real estate. So I would say you absolutely want to own real estate, but you the more you're in it, the more you get educated about who's making money, how to make money, how to lose money. So Chris Gambroulis at Ivory, shout out to Chris, but he teaches up at the MRED program at the U. He's taught a couple of really fun classes, but one of the things that made me laugh is he told one of the classes, raise your hand. There's 40 kids in there, right? And he's like, raise your hand if you've underwritten a development deal. and everyone raises their hand. He's like, raise your hand if you've underwritten a development deal that loses money. And everyone's like, what? It's like, not every real estate deal makes money, and that was kind of his point, is like, he's been in the business for 4 decades. You've just seen so many ebbs and flows. He just understood the importance of timing and underwriting those deals. So I think early in my career, I just recognized that I didn't know what I didn't know, and I became a heavy student of the industry, and I default to really wanting to provide value and hanging out with really great people. I mean, I joke that I've collected friends for a living. I don't really do real estate. I just hang out with really cool people, really smart people who have different angles and different expertise. Their 5 friends are different than my 5 friends. It's more of a personal thing. I think I'd have no problem owning real estate. I know who I would invest with. I know who I potentially wouldn't invest with, but I learned that the hard way. We don't need to get into that story, but there's just certain things you don't want to buy, and certain things I wouldn't want to buy, and certain people that I would want to invest with because I really believe in what they do, and they're all in, and they've been all in, So I think that's probably a long way of saying that it really just comes down to what your personal preference is. I mean, if you like to own properties and you like interacting with, tenants and, adding value and really controlling that creation and stuff, I think obviously there's a ton of value in owning that real estate.
And we love good operators. We have a lot of amazing syndicators that come on our show that we get to interview.
Yes.
We get to hear about how they build teams and, how they learn the business and became vertically integrated and learned all of this stuff to become great for their investors.
Of the dentist who's running a fourplex and killing himself because he gets done with the fourplex at 10 p.m. And then he's like, I didn't know I could invest in passive real estate. I didn't know that, you know, so.
2 perfect examples. Everybody's going to be in a different place, return on energy, return on investment, all that stuff. So and we love to see, there's so many incredible growth stories. We've talked about a few earlier, just like, here's their growth story. Here's where they started and here's where they are now. And you're like, whoa. It's just unbelievable.
Absolutely. Well, let's jump into the syndication side then, because we've been able to talk a little bit about what PREIshare is bringing to the marketplace with this secondary market for those fractional shares, which has really never been a thing in the past. What are some of the things that you've seen along the way of the frustrations of the LPs who maybe invested into a deal and didn't realize that their money was going to be tied up as long as it is?
Yeah, so first of all, I'm here because of what you've created, right? Like I as a broker recognize the opportunity for this because I'm also personally invested in deals. And every year we get calls from people that are like, hey, I'm a small investor in XYZ deal with XYZ developer, and I value liquidity right now for whatever reason. And they don't want to sell. It's not in the investment horizon, or some of these are never sellers. They're just evergreen funds or evergreen ownership. And there's no liquidity typically, so you guys are literally providing a solution that historically has been like, the other challenge I've seen is it's usually in partnership documents. You just can't go sell your units. You've got to offer those to the existing partnership, and typically no one's going to pay you a great market value if you need liquidity and they're fine. Not everybody's always in the same place. And so I see there's so much value in a marketplace. Let the market set it. If the deal sold for $100 million at a 5 cap, if you took the whole thing to market and you can recognize some differential, they're not lowballing you. You're going to get a market secondary pricing. I think it's beautiful because again, you don't have to sell too, right? However, knowing what that market value is and knowing where you are when you check in is awesome. You guys are providing a massive service to I think an untapped. Sky's the limit. You guys have done the math, but how much real estate's in the United States of America? 400 million. It's a lot. So.
I love that you mentioned, that historically, if somebody wants to sell their shares, they're at the mercy of the sponsor or maybe the other LPs in the group. And I'll talk to people on the phone with our listing hub that'll go, so let me just get this straight. If I don't want this deal, who else is going to want this deal? And it was like, look, you've got the whole world versus your one group.
Yeah, and for sure. We get calls all the time like, hey, what's my 13% worth? It's like, I don't know. I can tell you what 100% is to the penny. Yeah. But 13% depends on who's going to buy it. And usually it's going to be somebody else in the partnership. So like, Carl, I'll give you 80 grand,
It's usually greatly reduced.
Yeah.
Well, and that really comes down to if you can open up to the general market, then you can get all the different types of investors that are out there.
Right.
Because typically a syndicator they have to have a long-term horizon. That's how they become good in the market, is they can look at something and say, we're going to take all the different exit strategies as potential, but we're going to hold this as long as we need to until it makes sense. Whereas the individual who has a life event that comes up, they may need that money for one reason or another.
It's ticking.
Yeah. And so typically if they go back to the people in that market, those people know what they paid for it. They know what their need is, and they're going to negotiate to get the best deal that they can. You put it in the open market, and somebody that can see that this gets a better than market return with proven track record of the deal, now all of a sudden there's some upside to be had there.
Well, and I think one thing you guys already know this, but maybe the people we're talking to don't, I think it makes it easier to raise capital. Because to your point, if I need $2 million to go buy this deal and I'm doing it in $100,000 chunks, you got to find 20 people with $100,000, and maybe you find 10 and then you're stuck because the other 10, they might, hey, I could give it to you for 2 years, but like I might need it, and there's a lot of people. I mean, that's like that's me, like when the market turns, like I would have loved to have had some liquidity the last 6 months to a year just for fun, just to have it. So I think it's going to be easier to raise capital and provide the service. I also think we really haven't talked about this before, but we've sort of talked. We don't need to get into blockchain and stuff like that, but we've talked about the tokenization of real estate, and just what you guys are doing is that layer where all of a sudden it actually could create more value for people. Because if all of a sudden I can sell $100,000 of the Chrysler building and buy $100,000 of the Sears building in Chicago, and I can do that, with a couple of phone calls, and, all of a sudden liquidity should provide lower risk, which should, equate to higher values in real estate. So
we see that. And the other thing that we've talked about is, like you said, it's easier to raise capital when you can offer liquidity, because typically 7 out of the 10 people that do want to invest with you don't necessarily fit the timeline, because everybody has a different timeline. We also think on the big scale, because that's kind of what you're alluding to, is it'll actually bring down the cost of equity for the syndicator. Because if you can now offer liquidity, you don't have to offer the huge returns. One of the reasons that people get into real estate is the potential of the huge returns.
No, that's a great point. Why are the capital markets flooding to treasury bonds right now? It's because they're paying big dollars compared to historically, and they're liquid. So offering that in real estate is extremely valuable.
That's huge. What do you think that the biggest benefit to the market will be when there's a secondary marketplace like we've created?
I mean, this will sound crazy. I just think it's gonna be fun. Like we look at Crexy and LoopNet and Zillow and Realtor.com every day. It's like just part of our news feed. I think being able to look at that secondary market, I mean, you don't have to check in. I'm jealous of those that don't have to check in. Like I call it the homeless curve. Like I work with clients, they look kind of decent, and then they make some money, and all of a sudden they look super sharp. And then all of a sudden they make too much money and they look like they're homeless. Like, and I'm telling you, this has been through multiple clients and they know who they are. But I kind of get that sense here. It's like it's just gonna be fun to be able to check in, to be able to see what other things are trading. Like, what did this $100,000 in Sacramento trade for in this 1985 product? And, that compares to whatever I have, and now I'm looking at this brand new Class A deal in Orlando, Florida. I mean, it's just going to create an opportunity for education and learning, and they're going to get a visual into what I see every day.
There's a lot of excitement. We will market to people saying, hey, our listing hub is open. Come on in, place a listing. And about half the people we talk to are going, yeah, but how do I shop? I just want to get in.
Right.
I want it. So they're doing exactly what you said. They want to crunch the numbers. And they want to analyze, and they want to see how much of a discount they want to.
Well, some of the other benefits that we're seeing, the further you get into it, the more angles you get to see with this. Different people you talk to get to bring us these different insights. And that's one of the reasons I'm excited to have you here, actually. But one of the things they've talked about is the fact that now this dynamic re-leveraging aspect of it, if you could go and there's a good sponsor that does great value add deals, for example, and you could go invest with them early, and then you could cash out on that gain and go invest with them again, or in a different deal, or with a different sponsor. Now all of a sudden those double-digit returns that you're getting could be compounded on top of each other.
No, that's a great point. Investors that buy land expect a higher yield than those that buy the deal when it's done. So what you're alluding to is like being able to kind of play that game, and I think that's interesting.
Yeah.
Super exciting.
Well, the other thing I think that it could do to help brokers like yourself is when you're talking to folks and they're trying to figure out where to come up with the capital for their next move. Many times they just discount out anything that they have that's in a syndicated deal because they know that there's another 5 years or whatever it is left in there.
Yep.
And so now if people all of a sudden get access to this liquidity that they didn't have before, they can be more dynamic in their wealth creation.
Yeah. I think you hit it spot on. I think it's going to allow people to be in the driver's seat, almost like a self-directed IRA, which you could probably do in your syndications. But,
definitely can.
But yeah, just taking control of where, your future and what you want to be invested in when you want to do it.
Cool. Well, I would love to round this out and talk about the current market. What do you see? And we can talk about Utah because I'm sure that's your primary focus, but also what you see kind of on a national level and what real estate investors should be looking at.
Yeah. Where do we go? I would say high level, and I'll talk specifically to housing, right? I mean, the United States of America is in a great place demographically. If you count people for a living, we're where you want to be. Net immigration is high, population growth is high. Within that, we have areas that are doing really, really well. We have some areas that are, flat or declining. And so I think the overall thesis for the United States of America is you want to put your money here. It's going to continue to grow. And if you get into the Utah market, we stand out. It's awesome on every metric. Population growth, job growth. We graduate, look at all the colleges we have. So the young educated population, we can go from Utah State to Weber State to Westminster, University of Utah. UVU is actually the largest undergraduate, I want to say in the United States, 41,000 undergrads. No, maybe not in the United States, certainly in the state of Utah, 41,000 undergrads growing at 6% semester over semester. And that's next to BYU, right, which is 26,000. So I don't want to do the math because I can't think right now. It's Friday afternoon, but we probably graduate, maybe let's just say 100,000 seniors every year graduate. Utah needs housing. We're growing. If you look specifically at our market, and I'm talking really positive next 10 years, look at the prison redevelopment site. That was awarded to Colmena, Lincoln, Wadsworth. So we've got 2 local groups and 1 national that have come in to team up to go build that out. But if you're from Utah, I was listening to a radio station when they first started talking about that, and they said, who here has been to Lagoon? Lagoon is 100 acres. This is 6 lagoons. I mean, it's crazy. And it's connecting Salt Lake County with Utah County. Utah County is by far the best demographics in the Western United States. It's nuts. And now you're going to connect that. We also have Utah City, which Woodbury's doing with their partners. I mean, we just have these amazing things. We're not even talking about the Park City, Heber, all that stuff. It's like you just have so much and we're land constrained. And so anyway, there's so many positive things. Let me talk about the capital markets. Interest rates went from 2.5%, 2.75%. And we have clients that have HUD 220D4 loans, which are 40-year fully amortizing loans at 2.55%. I mean, that's crazy to think about. Right now, if you went to get that same loan, rates have come in a little bit and spreads have come in. We have a client of ours that's trying to lock in Phoenix right now at like 5.75%. Most of our quotes are still 6.25%, 6.4%. But those are down from 7. But I mean, it's really hard. No one's going to pay a 5 cap to get a set, and then borrow at 7% to get negative leverage, without an incredible story. So we have not seen a lot of transactions. We went from basically doing 1.8 billion in the first half of last year to about 330 million total in the state of Utah. The first half of this year. The second half is probably half of that. So we have a really strong bid-ask gap. And I'm probably talking too long, so I'll finish this up. But the reality is that Utah is performing just fine. So if you don't have a loan coming due or you don't have to sell, you're not going to sell. If I came to you and said, you just bought your house a year ago, you got a great loan in place, your family's happy, you bought it for $1 million, I'm like, I'll give you $725. You'd be like, I'm good. And that's kind of where we are in the market. The best story I have is a client of mine who's in a pickle. He called and it's like, hey, Mark, I'm sorry I haven't gotten back to you. Been really busy. Capital markets are working against me. Inflation's working against me. Like, it's just not working out. So I decided to let the lender foreclose. And I was like, by the way, we've never had a multifamily foreclosure, hardly at all. We had 0 in the GFC in Utah. So we're a safe place to invest. I was like, you're kidding me, And he's like, just kidding. So even
made me nervous.
No, even those who are in a pickle, like that's the attitude in Utah. We're stubborn because we know where we're going, right? So overall, we just have to get through this short-term heartache. We do have a lot of deliveries. Between last year and this year, we'll have over 14,000 apartments delivered primarily in Salt Lake County. So if you walk those units, they all look very similar. We've built a lot of the same stuff. And so I think in that genre, we're going to continue to see concessions pick up. Some places are offering 6 weeks free, 2 months free. We'll see if that picks up, and that happened really, really quickly. So we will see rents look like they're softening, but I think overall just the base of strength in our market is super strong. So that's a long way of saying, where are we? No, I'm just kidding.
Yeah.
We've talked about how great the real estate market is in terms of the growth, the population growth. There's so much going on. Time heals all wounds in real estate for anything negative happening, but I can't help but see affordable housing vigilante. The elephant in the room is, I literally have 4 out of 5 adult children right now that are like, Mom, do I just rent a room? What do I, it's tough out there for a lot of people. So give us your opinion on solutions, what to look forward to. What do we do?
No, I appreciate that. And I do have on my LinkedIn profile affordable housing vigilante. I've been involved in several affordable housing boards and what I would call affordable housing endeavors, also affordable housing rabbit holes. Affordable housing is really tough because most people look to the government, to LIHTC, low-income housing tax credit deals, to build their way out of it. Well, the problem is, have you ever built a $350,000 unit to rent it for $700 and made money? Absolutely not. And that's what they're looking to do in scale, and it's just we're never going to build our way out of it. There needs to be market rate solutions. So, there's so many ways I can go. I'll be really careful because I don't want to drag this out and make it a 4-hour show, but I've spent a lot of time in the affordable housing space, and there are some major challenges and major headwinds. One of the most incredible things about the state of Utah is Clark Ivory and Gail Miller got together and they started the Utah Housing Preservation Fund, which is a nonprofit set to basically buy and preserve what we would call naturally affordable housing in the marketplace. So one of the things that I saw when I spoke at the 2017 NAIOP Symposium here in Utah was that between 2014 and 2017, we'd already seen close to 4,600 units purchased, renovated, and rents increased on average $284 a unit. Not everybody that was renting there for $1,000 can pay $1,300. Where did all those people go? And that started this dialogue with Clark early on. The second best time to plant a tree is today, right? In theory, we would have loved to have gone back many, many years ago and planted so many of these trees because, as Clark has always told me, one, people drive to affordability in Utah. That's natural. But two, affordability is not a demand issue. We're already counting people. We already know that we're growing. It's a supply issue. You light up supply and all of a sudden it's affordable again, or it gives you a chance to catch up. And that's kind of what we're seeing in the Class A multifamily space right now is all of a sudden we went from double-digit 14, 18, 21% year over year rent growth to we're going to be flat for a minute, which is really good. It's a supply thing, but it is the elephant in the room. Our housing is crazy and interest rates going up doesn't help anybody. Right now, it's 3 times more expensive to buy a house than it is to rent a house. And I do a lot in the townhome space. So you can rent a townhome for $1,800 maybe, maybe $2,000 depending on where you are. There are some that are way nicer that we just toured. Shout out to Opus Green, Micah Peters. His units are insane. They're renting for $2,700 for ones and $3,300 for twos, just FYI. But they're a little higher end, not affordable. Okay, but to buy that same townhouse, you're gonna be spending $3,300, $3,700. I mean, it's just crazy right now, not to mention you have to get a down payment. So affordable housing is a major issue. People are looking to the government to solve that issue. They're never going to solve it, FYI. We need to do it through easier zoning and legislation to get apartments approved faster or homes approved faster. We need to do it through construction cost savings. We need to do it through financial means as well. No one is approaching this harder and faster than Ivory himself and their group called Ivory Innovations, which his daughter Abby runs. So if you want to, you could link to, it's called Ivory Innovations, and they've been giving out awards every single year. They've gone through over 600 companies that are basically in those 3 buckets. So legislation, finance, and construction, trying to solve the affordable housing bucket. The truth is, I've been down everything, every road, whether it's modular construction, offsite construction, you name it, micro units, stuff like that. I will say what is cool about it is we've talked about how awesome the market is and why you should invest in multifamily. You should, because there's so much pressure on housing and that's not going to get any lower. So there's a reason to invest in that. But there's also a fundamental reason to be very interested in affordable housing. Utah is no longer competitive when it comes to affordability. If you're a big company and you're looking at Austin, Nashville, Denver, and Salt Lake City, It used to be, well, we're going to go to Salt Lake City because we can actually pay our employees less and they live a better life. Well, if all of a sudden housing is on par with those communities or higher, we become less attractive to growth. And if we stop growing, I mean, we'll have less housing issues. But that's the balance, right? We want to continue to grow, but it's everybody needs to be involved in affordable housing. And right now we're getting so many people that are interested in that because they're starting to see how it's negatively impacting the people of Utah on every level. I feel awful. I mean, I live in Holiday, and it took me 20 years to earn my way back to where I could afford to live in Holiday, you know? And why? They didn't approve any housing forever. So Sandy City, when I started really in the development space in 2012 to 2014, their average age was about 63 years old. So if they didn't allow any multifamily apartments or any younger families to come in, what happens in 10 years? Everybody's 73. In 20 years, they're 83. So what communities need to be doing is constantly dripping in affordable housing. When you go to a city and you say, hey, we want to build apartments, they're like, not in our backyard. But what they don't realize is if somebody can't rent there, they can't figure out how to buy a house there so their kids can go to school there so that they can buy a bigger house and move up the ladder. And so we have to find ways to get people into cities where they want to raise their families and where they want to grow and where they want to be. And housing, affordable housing is a great way we need to do more in that realm. So elephant in the room, I can talk about it for days. We have some solutions, whether it's financial, whether it's from the state. There's all kinds of things we can talk about if anyone's interested, but it is a major issue.
Well, and I'd love to dive into even a little bit more of what are you seeing that's actually working?
All right. Yeah. Well, I say what I love about the need for affordable housing is people do get involved, and it's a data point from the market of a problem that we need to find a solution for. So we have lots of really smart people in real estate. One of the solutions is smaller units, right? Not everybody needs a big 3-bedroom or a big 2-bedroom with a view. If you're just looking for basic needs, and we've seen a lot of people take a jump in and really design really neat smaller units in downtown Salt Lake City. One of them I absolutely love, shout out to Dustin Holt and Bryce Baker of DB Urban. They built a product called a Key, which is 63 micro units, which I'm not the biggest fan of micro units, although they do serve a major purpose. These are smaller units, probably on average 475 square feet, but every floor has incredible common space. So you're not stuck in a closet, if you will. And so there are some design things that are happening in the marketplace to really fill that need. And again, a lot of people just need a place to start, you know? Aaron was in here earlier wanting to talk about Preston Cochran and the homeless facility that they're building, which are these small homes for the homeless. Well, what do people need? Food, shelter. You give people shelter, everything else solves itself. I'm telling you. Shelter is an incredible component of success on any level. You take somebody that's lost a job and lost their house and they're now going to be homeless and you're like, you know what? We got you. And that's what society should do. And that's what they're doing at Shelter the Homeless in Preston Cochran. Those people will not stay there in perpetuity. Why? Because they're going to continue to go back to a safe place, which gives them the confidence to go try things, you know, whether that's get a new job, whether that's meet new people. And that to me is like, it's a Utah thing. We got you. It's beautiful. And that will scale. And now I'm getting all over the place. But housing is just such an important component of a healthy society. And we really need everyone on board to support that mission. It's important from the state level. It's important from the government level, education level. I mean, you name it. The last thing you want to do is worry about where you live at night. It's pretty hard to move up in the world or provide for your family if you're wondering where you're going to sleep. And the homeless issue, we definitely don't have time to dive into that.
Well, but maybe we can dig in another time because I actually have worked with the homeless a lot myself as well. I worked with a nonprofit called the Legacy Initiative, and that was after I had pioneered just a one-off project where we collected over 10,000 items and we set up a store at the Gateway Mall and we gave it all away. So it took us 2 weeks to get the items. We gave it all away in 2 days. But what that really gave me during that time is to sit down and talk with these individuals and find out, because a lot of people just make mass judgments, and that goes in both directions, to be honest with you, right? People look upwards at the wealthy and they make mass judgments, and people look down at the, you know, the less fortunate and they make mass judgments. But what I found was just really, you know, the situations. But during that time is when Utah was pioneering housing first, and we saw some real traction be able to be gained with that by simply giving that shelter, like you're saying, and then moving them up the ladder. So I have all kinds of ideas that I'd love to talk to you about at some point of, I loved what we were able to do. We fed over 70,000 people with, going out on the streets, giving out burritos and helping folks out. But I always wanted to do something more to help those who are experiencing homelessness, move to that next step. Because sometimes once you're there, it's very difficult to move beyond it. Yeah,
that's cool that you did that. Yeah. And we can all do more.
Right. Now, on the other side of that, for the average everyday folks, and this is one of the reasons I'm such a big advocate of owning real estate, is I believe that owning real estate is the foundation of wealth. And if you want to keep your family here in Utah as it continues to get more and more expensive, part of that, I believe, is owning real estate. And I'd love to maybe talk about this topic because I truly believe there will be, third and fourth generation Utahns that will be priced out of this market if they don't decide to own the real estate that they live in.
No, that's an awesome point. And with affordability comes discussions of house hacking and how do I buy a duplex to do the math to lower my, monthly costs. It's no different than companies do when they look at buying multi-unit industrial buildings or multi-unit retail. I mean, how do we lower our operating costs, our costs of housing? And housing is obviously a major part of building wealth, and a vehicle to build that wealth. And obviously we're talking today about if you queue on anything, it's like housing, great. There's all this housing pressure. No one's solving affordable housing. The government's not going to solve it. The people can't solve it. You want to be in that space. But I think that if they say, don't wait to buy real estate and wait, right? We've all heard that. And that's going to be more true in Utah than anywhere else because we're not providing any short-term or really even medium-term solutions. We've got things that are in place like Utah City and the redevelopment side of the prison, 600 acres. We've got that in motion that's really going to hopefully relieve some pressure, but that's so far away. In the medium term, we just don't have those solutions. So what's the best thing we could do for our kids and our grandkids? Buy real estate, no question.
Yeah, I believe that.
We have a lot of sponsors that have done or looking at hotel conversions, and I have a very amateur question here for the both of you. I look at office, and everybody's saying offices are getting tougher and tougher to fill, tougher and tougher to rent. I wonder if there'll be any sort of office conversion, mimicking some of those hotel conversions. Do you see anything like that in the future, or is there just not enough to cover the problem?
I hope there's like a link where they can go to the extended version of this chat because I could obviously talk forever, right? I mean, I've converted hotels to housing. I'm working on several right now. One of the first ones I did was in 2008. It was the Chase Suites on 7th East and 4th South. A client of mine, Ben Massimino, who's now a big developer in Denver, but we did 2 HUD 220D4 construction loans here. One was 100 units called Brickstone on 33rd. The other one was 2550 South Main. He was trying to put that under contract. It's 128 units. It was the Chase Suites, originally built as a Marriott extended stay. And I had just graduated in 2003. Down the street, we're hanging out in this building and we walk in, I'm thinking wait a second, these are way cooler than any apartments I ever lived in. These are like extended stay hotel units. I wonder if they could be apartments. Long story short, the city said no because they were built as a hotel. However, I found the original plans from 1982, and on the front page, what does it say? It says for nightly or
apartment?
Weekly rental. No, weekly rental. So I walked that down to the city, and they said, all right, it was originally approved for longer term housing, 7 days. But 7 times 4 is a month. Anyway, so we got that approved. But then there's also been some other projects like the Oslo. The Oslo was completed by David Phipps and his group and his brother, Chris. And I forget how many units that is. I want to say it's 144, but that's right off of 45th South on the freeway. I mean, perfect timing, perfect solution for less expensive housing, right? Those ones they converted those to apartments and it's been a phenomenal execution and there are some of those opportunities. Jumping into office is really interesting because at face value, you see this timing, right? One of the reasons the Chase Suites worked is actually apartments, like rents were kind of doing this. Sorry, let me back up. Apartments are doing this, and the hospitality was kind of doing this, and we kind of hit that intersection perfectly because I think today they wouldn't sell the Chase Suites, but it just kind of that timing. I think office is in that unique space where you're seeing office come down, you're seeing occupancies lower, there's fear, what do we do with our office building? The major challenge is only like 7% of existing office space converts what I would say well to multifamily. If you think about it, most office buildings are 10, 20, 30,000 square foot floor plates, and they're big square boxes with elevators in the middle.
And 2 bathrooms.
And yes, and 2 bathrooms.
Okay, good point.
And so every building operates differently. There's no way to attack it in scale. You can drive a street and be like, you know what, I'm gonna look at this building. So kudos to Give Development, Chris Parker and Ashley Christensen. Kudos to Chris Parker and Ashley Christensen who bought the HK Tower. Give Development bought that. And that's going to be a combination of affordable housing. Believe it or not, they're actually putting a daycare in there because they're trying to service every level of need in our marketplace, essentially in that building. And we haven't really talked about the life cycle of housing. That's a whole other discussion, but cradle to grave, you know. But they're doing an amazing job there, and that is a cool conversion. But that building doesn't convert super well, but it converts well enough, and there was enough city money and interest in providing housing there. So you will see more. Hines is doing 136 South Temple. Most people know it as, I think, the Eagle Gate Tower. I don't do a lot of office, but that's one of the coolest buildings because the previous owner had redone that front with that really cool limestone facade. It's so pretty. And if you look at the actual office building, though, it converts really well because all I gotta do is put a hallway down the middle, and now you've got units looking north and you got units looking south. And so it converted really well. But I would tell you, most people that have done conversions across the US would tell you they would have rather have just built a building. The cost is really what you're looking at, your all-in cost. There's some buildings that even if you gave them to us, we're still gonna spend 300,000 a unit building it out. Well, we could just go build a unit, you know what I mean? So, but you can't give up the fact that it's space that's available that needs to be thought through. It is an opportunity, and you always have parking. Most office buildings are 4 to 7 parking stalls per 1,000 square feet, tons of parking. 136, overparked. Most buildings in downtown Salt Lake City are parked 0.4 to maybe 1.4 stalls per unit. And that thing's probably 4 or 5, you know, like just tons of parking. So there are some huge benefits to that. And everyone should be on the lookout for great office buildings and great hotels to convert because we need housing. And if they're struggling, let's just meet those in the middle and everybody wins. So great question.
Yeah, and you asked that, and I think about some of the interviews that we've done. David Zeff comes to mind where in Tucson, you know, he bought this hotel and he's trying to get into just a gorgeous, beautiful property, and it's affordable from the standpoint of it's really small units. So the cost to be in there is less, but it's because of the amount of space that you're getting. But the amount of amenities you get and the outdoor space you get is so far above and beyond anything that you could get downtown. And, you know, he's right off of the freeway. I also remember a group that we talked to, and they would be an approved sponsor with us right now, except that we're still only focusing on the United States, but they're up in Canada. And they've done 3 of the major office buildings that they have fully converted. And they're doing some really cool things that way. And so I think that when you see here in the larger cities where there is no infill lots available, there's just nothing to buy. Yes, you would rather go buy, but if there's nothing there, you might as well buy the shell and then strip it out and build from there. But it does take an extreme amount of cost.
Yeah, absolutely. 136 will be cool because we've got 2 towers delivering. We already had 1 Sky House deliver that Cowboy and Boyer did. These towers are going to set new records for pricing. So I would tell you that conversions start making a lot more sense when you're hitting $3.50, $4 rents. You know, it won't solve our affordable housing crisis, but it will relieve some pressure at the high end. And one thing that doesn't get talked enough about in housing in general is everyone's like, well, all you're doing is approving all this high-end home, you know, all these high-end apartments. Well, what that does is it relieves pressure from all the way down, up, right? Somebody that lives in a Class B can move into a Class A, which relieves pressure so somebody can move from a Class C into a Class B, and it just opens things up. So really supply helps, and converting those office buildings really helps at every level. We should all be advocates and fans of every housing project we can get our arms wrapped around. So we'd love to see some more conversions of office in our market. We've seen a couple successful ones. The first one was actually Paragon Station, which was the old, hang on, let me back up, West. I forget the name of the building. The first one was Paragon Station that Micah Peters did. The first one that I knew about, which was south of Vivint Arena, now Delta Center. And it was a conversion of the old Westgate office building. What was cool about that is he built 37 units, but none of them were the same because you could really play with those floor plates and make them super unique. But that was very, very high end and just incredible product. But it does bring you this shell that allows a creator to go, you know, do something incredible and add more housing to the market, which is valuable. So that's really cool.
guess going back to the modular, have you seen any modular solutions that work?
Modular comes down to cost. If I can go stick build a 3-story garden style walk-up deal and it's $240,000 a unit, and I'm going to go modular build that and it's $240,000 a unit, no one wants to really have to learn new things, and so they'll typically do there has to be a reason to go do that. And I'll tell you where modular has been very successful is in winter climates. That's why there's a lot of modular coming out of Canada, because your build season might be June 1st through September 8th, and so to be able to build through the winter off-site and then go do those in modular makes a ton of sense. We've seen some success in San Francisco where they've built hotels. It really hasn't been a price point thing yet here. We also have cities and municipalities that have challenges with approving off-site construction when they have infrastructure and personnel here to look at the 4 ways and approve things and that sort of thing. And so my understanding is that Salt Lake City would actually require you to build it here, even though you were going to install it modular. You couldn't build it in Reno and bring it here, if that makes sense. And so there's some code challenges to some of that modular as well. Do I think modular is the future? Do I think 3D printing is the future? Do I think, off-site construction is the future? 100%. There's a company in Springville, Utah-based, that actually started in the 60s or 70s. I don't know the history behind it. A gentleman named Joe Chen, who's an international investor, bought it a couple of years ago. Irontown's an impressive story, Utah family. They started because they were apparently they were big guys, and they were figured out how to move a house for somebody decades ago. Fast forward, they have a full facility there where they build offsite. The beauty of it is that I didn't realize is that the workers love it for 2 main reasons. One, they can go there at 9 o'clock, they can have lunch with their wife at noon, they can go back at 1, they can work till 5, and then they're out. If you need to increase production because it's all there, you can now run 24 hours a day. The second reason they love it is if you're an electrician, you go do your electrician work there, but hey, maybe today we're doing roofs. So you learn roofs. Maybe the next day you're helping out doing the kitchen, surrounds and tubs and countertops and plumbing. And you come out of that as a person and as somebody in the trades. Wow, right? I mean, you are incredibly valuable, but you're also not waking up at 5 a.m, driving to Park City to build this house for a couple hours, then you have to leave at 3 because your kid's got a soccer game at 6. Offsite just brings a lot of value across the spectrum. So,
and it's interesting because I just learned about some of these challenges from you as we were talking in the green room of this whole, you have to have it approved where you're building. Is that by city level or is that by state level? If we set up one large facility in, the south end of Utah, for example, can we use that to build here locally in the Salt Lake Valley, or do we actually have to have locations in the particular city you're wanting to build a complex?
So again, my understanding, and I don't develop, but it's that cities really don't like offsite, and maybe it's a tax thing, maybe it's an income thing, maybe it's oversight, maybe it's a combination of all those things, But if all of a sudden somebody's buying wood and buying bricks and sticks and they're building it in California and it comes here, I mean, I'm just conceptualizing maybe what some of the issues are. But yeah, there's been several groups that have looked at doing some modular construction here, and they've kind of been met with one of them was Kozo House, which we've been working on, which that was originally designed to be modular construction, and they ran into some issues at Salt Lake City. That was their feedback to us, and so that had to be redesigned to be stick built. But why haven't we seen some of the major home builders move in that direction? I don't think there's enough of a cost savings. A 2x4 taken to Park City is going to be the same as a 2x4 taken to Springville, and I don't think we've seen quite those savings. So where you win is in volume play, and also if you need to increase production, or you're doing that to build offsite like in a Jackson Hole or a Truckee, California, or something like that, where you have a really short build season. So it'll happen. It'll continue to happen. I think it's a combination of all those things working themselves out, and you'll see more of that. I loved the facility. It was neat to see nothing to a framed house moving along a conveyor belt almost, if you will, around this warehouse. And then all of a sudden you've got one of 36 hotel rooms that are being shipped to Jackson Hole, Wyoming that will literally be installed in 18 days. It's like, how could you not see the vision that is the future? So it's coming.
Yeah, that's cool. Very cool. Is there anything else that you'd want to share with our audience around the syndicated real estate space and the secondary market that is now available?
I would just say start learning. I think it's so cool that you guys do this show and you bring on amazing speakers and guests to get educated. I think that's probably an offshoot of what you're trying to do is educate the general population. I think what you'll see is the groups that not everybody can go raise money. They put together all these things where you have to be a, what do you call it? You have to be a bona fide investor or a certified investor.
Oh, accredited investor?
There you go.
Yeah.
Bam. You can tell I haven't raised money, right? You have to be an accredited investor in order to invest in some of these things. And the government does that to protect those. But, you had other ways of raising money through crowdfunding that you could invest as little as, $1,000 with some of these groups. And I think that's right now where if you can imagine 1,000 people pitching in on a deal that was bought in 2021 that's now has a loan coming due. The reality is that being able to have that liquidity would have created those opportunities where if they wanted to get out, they could have gotten out. If they want to get in, they want to get in. But you're offering them the opportunity to get educated, which is absolutely everything. I mean, the worst thing you want to do is lose any money. And what you want to do is you're trying to improve yourself and improve your family's position financially. And in my opinion, there's no better way to do that than real estate. And not everybody can go out and be all in. So you guys are offering such an amazing platform for those to be all in, but still have the comfort and safety of knowing like, hey, like if I need to, I can access that capital. And that's huge.
Yeah,
so
we really want to advocate for those passive investors.
Yeah.
But we also want to celebrate those good syndicators out there, the ones that are doing great business, and we want to make the industry better as a whole.
I love it. The hardest thing to do is raise money for your first deal. That's where I wouldn't want to say like anything negative about any syndicator, because some of the best syndicators, did they make mistakes? Absolutely. So I love what you guys are doing. It's going to marry individuals that want to invest with those who are experts in the marketplace, and you're going to be able to see their track record and what they've done. And I think we've learned a lot the last couple of years. We're in a great position. One of my favorite quotes is a client. I was really sad once, and I said, I think I'm late to the game. He's like, Mark, are you late? Or are you really early? And it's like, boom, here we are. We're at this perfect place where we know where we are in the market. We've learned a lot. We know we're not at the peak. So it's a great time to jump in. You guys do a great job, and I appreciate the opportunity to come, talk on your show.
Absolutely.
Perfect. Thanks for being here.
My
We
pleasure.
really appreciate that. We had one of our partners, Aaron, in here earlier, and he said, if you want to know what to do in real estate, follow the CRE guys.
Yeah.
So it's really fascinating to hear and understand your broker opinion, and especially in our state. So thank you.
Cool. I know. I appreciate it. You guys are doing awesome. Christian, it's fun hanging out with you. So thanks.
Do it again. And thank you guys for tuning in for another edition of the Fundication Show. We'll see you next time.
Goodbye.
Well, thank you for joining us for another edition of the Fundication Show. And right now, we are in beta phase with our listing hub. So if you would like to get a free listing of your fractional share in a real estate syndication, just go to thelistinghub.com.